Okay, welcome everyone. This is the Jumpstart webinar. We're talking about VC 2.0. But I have Dave Lambert and Brad Zapp with me, really two of the leaders of this movement. I think I've posted about it a lot. The old-fashioned way of doing venture with 3 to 4 guys sitting around a board table, kind of looking at deals through their personal networks and using the intuition to pick winners, and then, in quotes, helping by making some phone calls and a few introductions. That maybe that worked in the 80s and early 90s, but it's dead now. And unfortunately, the message hasn't gotten to a lot of VCs, and they're still using the same old tactics that are, pretty outdated, 20, 30 years outdated now. And so a lot of investors have gotten frustrated. The results have not been great. And what I wanted to point out today is that we all know that, but there are some emerging funds like Rightside and Kinetic that we'll talk about here that really have changed the model and thrown out all the stuff that doesn't work, reinvented how to go about things. Jumpstart certainly has been working on that too. And I think it's much more interesting to talk about, what is working and how we really sort of generating the outsized returns in a consistent and repeatable way. And maybe we should look at investing in that and letting the old VC dinosaurs, stagger off into the tar pits. And so with that, I want to bring in my two guests. And so Brad, maybe give you a quick summary, and then Dave, give a quick summary of who you are and which fund you represent.
My name is Brad Zapp. I'm the managing partner of Kinetic Ventures. Personally, I've been an entrepreneur my whole life. I'm a 5-times founder, and we are a $30 million VC located in the greater Cincinnati metropolitan area.
Hey there, I'm Dave Lambert. I'm one of the founders and managing directors of Rightside Capital. We're a quantitative, data-driven approach to a segment of the market that we call pre-VC stage investing. We tend to invest in companies raising small rounds that are smaller than even what seed and pre-seed VCs address. And we've invested in over 1,000 companies since 2012.
Excellent. And I think everyone knows I'm Vic Gatto. I'm co-founder and CEO of Jumpstart. We're a health-only focused new venture platform. And so, Dave, maybe just give a little more background in how Rightside, how the thesis works, how you sort of are able to sort of make this scale of investment and have the success that you've had.
Yeah. So a few things to touch on. So the first thing is, there's a few big things that we do differently than traditional venture capital firms. So the venture capital model as a whole is just 100% labor intensive generally. And what we've done is we've leveraged technology and built out our own back end to sort of do what startups do, is leverage technology to scale. So we're able to ingest data about thousands or 10,000s of companies and sort through a much larger number of investments and make much quicker decisions. So rather than doing a lot of the subjective analysis that if the 3 of us were partners at a firm, it could take us 2 months to analyze a market and make our projection of if it's going to be big or not, or where it's going to grow, if there's going to be demand, the future of this company. And instead, we'll take in, a couple dozen, plus or minus a dozen data points about a company and make a very quick decision based on those data points and a specific valuation. And that allows us to build these ultra diversified portfolios, because ultimately part of our thesis is that in the last decade, there's just been an explosion of demand for much smaller size funding rounds. And part of this happens because the cost to build a software product has just collapsed. It's dropped by over 90% since 2010. So you can build even an enterprise product and get it live without a lot of capital raised. And so while there's been this explosion of demand, there hasn't been, the investor side of the fence hasn't stepped up and provided more capital at that segment of the market, because the 100% labor intensive model of the VC world doesn't work to spend 2 to 4 months looking at a company and then write a $100,000 check, and to do that hundreds of times. So what we've determined is that returns are much higher at this stage It's also a bit riskier because you're investing at an earlier stage, and it's a very skewed distribution of returns and return curve. So we solve for that by building out funds that have hundreds of investments instead of 10, 20, or 30. And the end result for investors is a extremely high return with a very smoothed out risk curve. Like there's a very low risk of capital loss, and we have a very high sort of return band of fund multiple ranges. And what we really love about it is it's not just great for investors, but we're also providing capital to entrepreneurs, at the stage and segment where it's needed most. There's so little capital available when you're looking to raise $200,000 or $300,000, particularly when you're doing it outside of like the Bay Area or New York City. And also it allows us to give entrepreneurs this product that they really want, which is this incredibly fast, transparent funding process. So because we have a very relatively narrow investment profile, we just publish that on our website. And we're very transparent, and we tend to give entrepreneurs a yes or no in about a week. And they just value that so much. So as I've been a career entrepreneur before launching Right Side Capital, and I love how what we're doing sort of solves for the pain points that exist on both sides of the funding fence.
Yeah, excellent. Good. Well, I want to come back to some of the details of that, but Brad, talk about how Connect works as compared to Right Side.
Well, first off, I would say I believe in every word that Dave just said. And I think that's important because I know we'll talk about it later, but it's going to be a mega trend that I think you're going to see come down to not just venture capital, but other private market alternative asset class. So at Kinetic Ventures, we're an early stage investor. So we use that term very broadly. So we typically are pre-seed all the way through Series A. And we invest in innovation-driven enterprises that are both products and services companies. So our fund sounds like Dave's. We are broadly diversified by industry. We think, one of the pillars of broad deal flow gives you the opportunity to create a broadly diversified portfolio. And just like Dave said, that smooths out the risk profile. The problem that traditional VC has, which Dave already hit on, is it's highly labor intensive. And if I was to expand on that, if you think of the model of all VCs, you still say no 98, 99% of the time. So if you're a labor intensive, then the VCs are spending their time, and time equals investors' dollars, on companies that never end up in their portfolio. So if you could flip that model upside down and figure out a way to use technology. So like Right Side, we also have built a completely custom proprietary backend where we can assess a company's, thumbs up, thumb down in real time in less than 20 minutes. That allows us the unlimited number of companies could come through our portal in a single day. And, basically what we do is we want to make sure that when the humans do get involved, that we're spending our time on companies that either we are likely to write a check to now or in the future, or maybe more time on our portfolio companies so we can use our networks or our personal expertise to help drive returns for investors. So
yeah, so it's really interesting. Connect and Right Side, San Francisco and Cincinnati. I don't think y'all knew each other before the last week or so, but the opportunity, the capacity in the tech stack and in the data markets now sort of have enabled this for entrepreneurs to grab information and just be much smarter investors. Jumpstart, I think everyone probably knows, but Jumpstart, we do a similar thing, but focused only on health. I believe that health is, it's a huge market, but it's highly regulated and not as easy to navigate. So we invest time and effort in really trying to understand those regulatory and kind of reimbursement rules and how that interacts with healthcare. And we think that further specialization just allows us to tweak our algorithms. And we have the same thing that all three of us have, which is a much automated process. But then we weave in that sort of regulatory aspect that I think is required to be successful in healthcare. So I want to talk through this portfolio model. All of us have moved to kind of grab the opportunity, but alleviate the risk by broadening significantly. And so I want to come to that, but just before I do that, someone just put a question in the QA post. So I want to point out, certainly we want to answer your questions. So feel free to put these in the QA section. I'll touch on them as we go, or we'll come to at the end. You can also use the chat. We'll use it kind of interchangeably. So as we're talking, if something springs a question in your mind, you don't need to wait till the end, just dump it in there and we'll address it kind of as we go. Both these guys are very fluid and able to can sort of do things on the fly, I think. So, so Brad, maybe talk about how you came up with this idea. What did you know about the venture world? And then talk to me about like what did you change first and how did it evolve at Connect?
So the 30-second background on myself and my two other partners is we have finance and data science backgrounds. So that's just important to understand sort of our stripes. So we were already in other forms of our life prior to being venture, we had already used data and modeling to help make decisions. So I was a professional capital markets investor prior to starting this. And if you think of the capital markets, it doesn't matter who your broker is or your financial advisor. You wake up every day and we all have the same sandbox. There's 4,300 publicly traded companies and they all show up on Bloomberg. They all show up on Fidelity, Schwab, doesn't matter. So you just have to pick them. But in the private markets and early stage venture capital, it's largely geographically constrained. So if you think of whether it's coastal VCs, 34% of every dollar spent in America happens within 100 square miles. So when we hung our shingle, I'm from Greater Cincinnati. Technically, I'm from Covington, Kentucky. We're in the middle of frickin' nowhere. You know how many VC deals happen in our town? 0. So we had a problem right out of the gate, and we thought we were geniuses because we live in the area that's called the tri-state. And we said, okay, well, we'll do deals from 3 states, Indiana, Ohio, and Kentucky. And therefore, we have 3 times the deal flow of everyone else.
Yeah,
well,
and what you did, except it was 3 times 0.
Exactly. So it still was garbage. And so once we learned that if we're not going to invest in San Francisco companies and we're not going to invest in Boston because that's not what we do, we need rest of country. And that's 1.7 million square miles. So once we figured that out and we calculated the cost of all that air travel, we knew we had to create software. Software has distinct advantages. It lives in the cloud. It never sleeps. And so we developed a software named Wendell, and Wendell's a bot. Wendell talks to startups. He remembers everything you tell it. And so far, he's immune to human viruses. So I'll stop there because I know we're going to talk more, but that gives you something to think about.
So Dave, maybe build on that. And then we've had a question come in about, okay, these proprietary algorithms or intake models are great. What actually are some of the criteria that you look at? You don't, of course, don't give away the secret, but you publish it. So give some aspects of the secret and build on how you're broken from the traditional model.
Yeah. And maybe before I do that, sort of maybe 20 quick seconds to build on what Brad said. Like our origins were very similar. There's 3 founders here. We're entrepreneurs, but one of us comes from financial services world, one sort of a quant that dreams math models in his sleep, and one is a person who's, started and ran a lot of software, hardware businesses. And we basically started with a clean slate and said, let's ignore any perceived best practice in the venture world, and let's build out let's take basic portfolio theory and math and build out what we believe would be the product that best serves the entrepreneurial needs and drives the best returns to investors, and just sort of started from that blank foundation and ended up somewhere pretty close to what Brad's doing. And even though we're based in San Francisco, we primarily invest outside of the Bay Area for probably a lot of the similar reasons. So getting to what are some of the things we look at? So it depends a lot on, business model. And so there's a lot of nuances depending on exactly what a company is doing. But at the high level, we're ingesting in things where there's pretty much the answer to what we're looking for is a number or a yes or a no. So instead of, do I like this founder? Do I like this business model? Do I like this vertical? Do I think this market's going to grow, as sort of subjective analyses? We suck in data points like, what's your current revenue? What's your, what's the curve at which your revenue is ramping? How much capital is it taken to get to where you're at? What's the profile of the founding team look like? What's your cash burn right now? What are your anticipated, uses of cash and cash burn over the next year? And these are all things that, are very easy to gather because they're real numbers behind them, or they're yes or no questions. And then we suck all of that up, and we're able to, we basically look at profiles of companies instead of an individual company. And I think the biggest secret sauce about what we do compared to what I did as an active angel investor for 15 years, what any venture capital firm does, is most investors try and evaluate a specific company, and their diligence is all about trying to assess whether this specific company will succeed or fail, and to make that prediction. And what we do is we come in and we say, well, we're investing at such an early stage. If we want to be really accurate, let's just predict that everyone will fail, because I'm going to be right more than 50% of the time. So now that I've predicted with as much accuracy as possible, what else can I know? And what we do is we turn a company into a profile. And then we look at that and we say, all right, if we invested in 100 companies with a similar profile to this one at this valuation, would that be a good pool of investments? How would that pool perform? And that pool could perform really well because we think 40% of those will be successful, and a high percent will be moderately successful. That pool of 100 could perform really well because we think actually 85 or 90% will fail, but 5% will be wildly successful. So there's no sort of secret magic exact profile that's ideal. But when you look at the world that way, you make very different decisions. It allows us to take more risk, and we're so diversified, taking more risk doesn't matter at a company level. It also allows us to invest in company profiles that VCs wouldn't touch. Like if we come across a company and their plan is they're probably only ever going to raise $1 million and get cash flow positive and grow, no VCs will touch that. They need to get millions of dollars into companies because you can only have so many companies. And so it allows us to invest in profiles that are just very attractive, that are just not relevant.
It's kind of on both ends, all over the place probably, but I can at least think of both ends of the risk profile. Like you might have a company that is, the profile is, let's raise a little bit of money and cash flow quickly. It wouldn't be, it would be too much work effort for a VC to invest in that. But the risk profile is pretty low risk, and it's good return, but low return. You also could do something that's 1 out of 100 risk profile, but pays at 1,000 to 1. And if a VC is doing a portfolio of 12 assets, that don't work.
Yeah.
But if your portfolio, it might work.
Exactly. So it's not a problem at all if we are building a fund that has 800 investments in it. If 30 of them are profiles of ones, or 60 of them are profiles of ones where only a few in 100 are going to succeed, that's okay. You'd be insane to do that if you're building a portfolio of 30. And to maybe talk a little bit more about like what's it mean to turn something into a profile. Maybe I'll just give you a quick description. If we were 3 partners and I had found a company that I thought we should discuss, normally what I would do for sort of a standard venture firm or angel group is I would talk to you about what this company does, the product they've built, the customer they're trying to sell to, why I think there's going to be demand for this product. And at Right Side Capital, when we discuss it, we might be talking and say something like, all right, here's a company that has 25K MRR. They've only raised 120,000 to date. It's a 3-person founding team, 2 people with previous startup experience, 2 with technical expertise. All 3 have domain expertise. It's a $1,200 a month B2B SaaS product targeting a niche vertical. They're only burning $20,000 a month right now, and we can invest in this at a $3 million valuation and lead a $500,000 round. And we would look at that and say, all right, if we invested in 100 companies, all of whom had 25K MRR, a $1,000 plus monthly price point, had raised only a little over 100,000 to date, and started out only burning 20K a month in cash, a pool of 100 of those at a $3 million valuation is going to be one of the most successful VC funds ever, probably. So we're likely going to invest in that company. And it's interesting.
So we do a similar thing in the healthcare space where we have profiles that are a combination of financial metrics, but also where they fit in healthcare. So maybe they sell to insurance companies and they're this profile. We name them. So base hits or big swings, or there's different names that we use internally. But then what I want to bring up is, at least for us, we've modeled that over time, right? So we had assumptions 6 years ago when we started that were kind of directionally right, but weren't actually right. And then each year we get actual feedback. And so we learn about the profiles and we know, okay, this one needs to be adjusted. It's okay, but it could be better. And this other one we're going to kill. And
completely. I can give you some examples of some learnings that we did along that. So like when we started out in 2012, 13, 14, we didn't, we didn't have enough data to start narrowing things in. And we invested in some companies that looked like incredible profiles, and they looked like on a path to be sort of, performing that top 1 to 5% in their areas. And what happened is some of those that we invested in did end up performing, I'd say, in the top 1 or 2% of the distribution curve, but they happened to be in sectors or areas that got very low multiples, even if you're successful. And so one of the things we learned early on was that, a lot more matters outside of just specifically what that company is doing. So like there are certain profiles of business models or sectors that we ignore completely, because even if you happen to invest in a company that performs at the 98th percentile, it's just going to be a good investment. And I want to invest in companies where if they're in that 98th percentile, it's a freaking awesome investment. And when you do that, sometimes you get lucky. Like COVID hit, and actually, an ultra diversified fund like ours is going to sail smooth through sort of a shock like COVID pretty smoothly anyway, which all of our funds have. But sometimes some of the adjustments we get make you a bit lucky, or it's sort of good. So like one of the changes we've done, as of a few years ago, is we tended to avoid almost any company that had a business model where their customers were brick and mortar retail. And it wasn't because we thought a pandemic might be coming. It's just simply, brick and mortar retail is just very stressed, financially, and it's not that attractive, and it's a much higher risk point when a company you're investing in has all the customers that are on the verge of bankruptcy.
Cost is hard too, I think.
Right, and so by avoiding that for just pure financial reasons, we sort of got lucky and missed having a lot of exposure in an area that was really harmed by COVID.
Yeah, excellent. So we had another question come in. Brad, maybe I'll kick it to you and then we'll circle back around. So there are incubators in every large city. There's an incubator and an entrepreneurial support unit. Sometimes they offer real estate, sometimes they offer education and guidance. And then I'm going to throw in there's accelerators, which is really, I think, just an incubator that puts a little money in. That's my definition of an accelerator. And so what's our relationship with those groups, incubators and accelerators? Do we compete with them, or are we are they feeders for us? How do we work with those groups? Brad, you take it off, and then I'll follow up with my thoughts, or Dave, they can.
They're certainly not competitors. So focusing on accelerators, Accelerator is like school for entrepreneurs. So it's curriculum based and it's time based. So you come to the accelerator, whether it's virtual or in person. It's a 1 to 5 month program, and then you have some sort of event that culminates the graduation, which has been typically demo day. So, relationally, they're certainly a feeder, but when you're working you're trying to capture every possible deal flow, then any deal flow source, it is a certain feeder. I know it is for us. So I call accelerators and incubators ecosystem builders. So if you think about any entity's agenda, so a venture fund, my agenda for my LPs is very simple. You give me $1, I give you back $2. We're going to keep playing that game for a very long time.
Right.
So
I tell people, I might create jobs, but I'm going to create as few as possible. I'm going to create money, and we'll end up doing jobs.
Create money. And if we happen to be good for our community, all the better. But if you think of ecosystem builders, and we need them and it's great, but the agenda is slightly different, is they're there to create energy, buzz, good for the community, jobs. And if they happen to make money, you know, that's.
Yeah, well, we might have lost.
To Accelerator is, you know, usually let them, hey, we're Kinetic, this is what we're into. I want you to, you know, send all your companies talk to Wendell. So the more companies that we get to talk to Wendell, the smarter Wendell gets, the better we're going to do.
Yeah, so talk about that. Are you letting it actually be full on machine learning? Is it supervised? How's Wendell learning?
So Wendell is getting smarter. We went through, so Wendell is an AI bot. And when we started, it's full on automation, that's for certain. But currently it is a supervised learning algorithm. Mm-hmm. So we've not let it loose because we do not, and we have not had enough data points to go through this that we're willing, you know, to turn it loose. But Wendell's behavior is like a sorting hat, if you've seen the Harry Potter shows.
Yeah, sure.
And we are doing the exact same thing in a different way that Dave's doing, is we're creating profiles. And our profiles show their face in the form of a star rating. So you either got a 1-star rated car, there's a company, 2-star, 3-star, 4-star, 5-star. And we're also trying to come up with the exact same outcome. So if you look at the portfolio of companies we've had since we've been doing this for about 18 months, we have approximately 1,500 companies that have come through to give us approximately 100 data points per company. We track the outcomes of every single company. And if you look at the broad base, roughly about 65% of the companies who have had a conversation with Wendell are on a bad trajectory, or they've already failed. Mm-hmm. But once we start sorting these into profiles, if I look at the two extremes, about 89% of the 1-star profiles have failed. So that's good, because that's what we would expect. Yeah. And about 81% of the 5-star companies have either performed, have exited, or are on a performance trend. So if you think of that, if you apply that, you know, on a very concentrated portfolio, that type of style probably won't work. But to Dave's point, the bigger the portfolio you do this, you'll probably be one of the most successful venture funds of all time. So the trick is find an ingestion model that's infinitely scalable, so you have choice where you can apply large numbers. And then the final point to wrap it up on the machine learning, we absolutely use machine learning. So we have a full-time, 2 data scientists, and they are running algorithms all the time. Our dream of where we are going with this is we are going to let loose Wendell, the unsupervised bot, soon enough. But that doesn't mean that I'm going to let Wendell write the checks. And so we call it the airline pilot model. So you know how you walk, when you walk onto an airplane, or when you used to, you look to the left into the cockpit, and there's 2 pilots and this giant supercomputer. Now, you know that computer flies the plane during takeoff, cruising, and landing. But if anything happened to that computer, the pilots are there to take over. But as a passenger, I feel a lot better that they're together. So that's the relationship between the VCs at Kinetic and Wendell. Wendell works for us. He tells us what we should invest in, and he's pretty good. But at the end of the day, what we're looking Wendell to do is sort out the different opportunities into these profiles that says, hey, here's this group of profiles, maybe a dozen per month. Why don't you humans take a look at this, see if you agree with this, and let's write some checks. And that's how we do it.
Yeah. And what's interesting is that I think all 3 of us have just kind of reversed the order where, so I was a VC for a long time, and an entrepreneur would send a deck or something into me, and then it was on me or people that worked for my firm to sift through that and read it and try to interpret it and do all this work. And I kind of got tired of that, and that doesn't scale, right? There's only a small set of GPs. And all 3 of us have now reversed it and said, here's the forms to fill out. Here's the information we need. And you have a great name for yours, Brad. I haven't named it. I don't know if Dave has a name for his. But take your time And you know, maybe it takes half an hour, maybe it takes an hour. Depends. For us, if you have all your stuff together, you can probably do it in 25 minutes or so. But a lot of entrepreneurs don't have their stuff together, so they have to go find things. But if we're accepting 400, 500, 800 applications a year, that's a lot of man hours that we're sort of putting on the entrepreneurs who really, they know it best and they're motivated to do it. So I mean, that's like the first big shift, I think, because then you can take, then I want to take all I can get.
Yeah.
I want to elevate one thing that Dave said that I don't want to get lost, because I totally agree in this. When he said that because of his model, he's able to invest in many deals that traditional VCs won't, I totally agree. But I'm going to put numbers around that. So the traditional VCs fund approximately 6,000 companies per year. So mine and Dave's model and your model, we have an opportunity of upwards of 125,000 companies that we potentially could fund. That is a huge sandbox, huge opportunity that we have, and we have models that can ingest that. Traditional VC cannot compete in our landscape, but we still can play in their sandbox. I think that's really important for investors to understand.
Yeah, I totally agree. And that's part of why we're all friends and we collaborate, right? It's a big sandbox. There's plenty of opportunity.
And what happens, what's interesting is, you know, it's all about, you know, it's still very outlier driven, but the outliers, you know, by definition, because they're outliers, they come from surprising places. So, you know, as an example, we have a company in our portfolio that we invested in, you know, about 4 years ago, and it's a B2B SaaS company, but it was a relatively low price point, and it's a profile that, you know, their intention was never to raise large amounts of capital. And so it was just not something that was attractive to sort of any traditional venture style investors. But at the time that we looked at them, they had gotten to like 20K MRR with, you know, almost no capital raised and a lot of domain expertise. That's really good. And, you know, you fast forward a few years later and everything clicked into place, and that company's gone from 1 million to 10 million ARR in the last 18 months without
very little capital. And so
with
like,
no capital raised during that time, from 1 to 10, like almost unheard of in the B2B SaaS world. And now this is a company that's, you know, going to be worth hundreds of millions of dollars. And it's one that at the onset, you know, we would have thought, all right, this is a company that, you know, the most likely outcome is one that's going to sell in the $30 to $80 million range. And because they haven't raised much money and we got in at a low valuation, we could still get a 10 or 20x return, you know, but now we might end up getting.
now you might be at 100x or something.
Yeah, we're on track now for a potentially 100x plus return. And it's not from the profile that you would have thought would be the most likely to give you that 100x. So when you're really diversified like that, you know, the outliers can bubble up from almost anywhere. And basically a lot of what we're doing and a lot of what Brad's doing is capturing those outliers. Like ultimately, so many of the returns, when you say, what's it mean to come from the top 1% or 5%, you know, drives a lot of the liquidity. Well, that's a 1 in 20 outcome or a 1 in 100 outcome, right? If you are the best investor in the world and you invest in 30 companies, you'll probably get 1 or 2 1 in 20 outcomes, and you're probably not going to get a 1 in 100. You know, if we invest in 800 companies, you know, we're going to get on average 32, or actually 40 1 in 20 outcomes. We're going to get on average 8, and it might be 6, it might be 10 1 in 100 outcomes, and we got a good shot at a 1 in 1,000 outcome. And you know, that just the certainty of capturing.
That's how the math works, but I would argue the quality is also getting better because of the way you can ingest a ton of information and learn from it.
It's incredible. Like one of the things we've seen from when we've started till now, from like 2012 till now, one is we have so much more data. We have so much more sort of an asymmetric data advantage over the rest of the field. Yeah. But the other thing that's happened is we've been in the right place at the right time. So, you know, we primarily invest in companies that are raising, you know, small rounds, just a few $100,000, you know, sub $3 million valuations. And back in 2012, 13, a company that looked like that was pre-revenue and building a prototype. And so our first fund invested in hundreds of those, and our first fund's crushing it off of a starting point of hundreds of companies that are largely pre-revenue. Well, in today's world, you know, companies raising $200,000 or $300,000 at a sub $3 million valuation, our average company has 10 or 15K of revenue per month.
Right.
And so,
Yeah, so their staying power
is so powerful.
So much better, right?
Yeah, it's so much better entry points, so much more de-risked. Good things happen so much more quickly when everything's starting with revenue, and yet it's the exact same valuation and starting point. And so math sort of becomes a tailwind at our back. It's almost like we're the casino where, you know, the math just always works out in our favor over the long run. And that's what we're really trying to build. And it's what excites us.
Yeah, so I want you all to give your impression on this, and I didn't prep you ahead because I just thought of the question right now, but I think we'll be able to figure it out. So, I mean, it strikes me that both of you are picking a stage and sort of grabbing a ton of information, whereas Jumpstart is more niche focused in one area that's honestly a little more qualitative, a little more messy because it has this regulatory stuff. It's my belief that that's going to continue, and 10 years from now there'll be I mean, you all will be the sort of grandfathers and have sort of started the whole thing, but there'll be spin-offs like Jumpstart that focus in one area, or maybe they're later stage. I mean, Dave and I both know a debt fund that has similar things. Does that make sense to the two of you, that like as the models mature and as the technology gets better, you could use it in messier markets?
Yeah, and I'd say what you're doing at Jumpstart really is in many ways you're taking qualitative information that you've got about, you know, as sort of an expert and having done so much in this sort of niche sector, and you're quantifying that qualitative information to help you build profiles that you're looking for, right? So
we're right. I mean, I think that's probably right. The way we talk about it internally is we're skewing the scoring system based on the qualitative view of where the next 3 to 5 years of the market is going to play out. And we need to be right about that qualitative direction. But then if we are, the outcomes are, you can do really well in healthcare because it's a messier market.
Right. And part of it, it's like, what's a qualitative and what's quantitative? Like, you know, I think what you guys are doing is closer to some of the stuff that you call qualitative, I would maybe call quantitative. Like a lot of your qualitative stuff is you going out to large healthcare organizations and talking at the top and finding out what is it that are their biggest challenges, what do they need, and what are they looking to acquire over the next few years. And that's, you know, in some ways
right.
that's
I think it's
but then
we
you
just
turn
don't
that
have
into
the right
quantitative
terminology.
process.
Like, it's not as 1 and 0 as how much revenue did you have last month.
Right.
If we talk to 30 big health systems, it gets pretty organized and kind of set up. So Brad, we had a question come in about Wendell. So Wendell knows a lot about the future direction of the company, or at least has opinions, pretty informed opinions about where. The question is, do you provide feedback to the entrepreneurs when you invest and when you don't invest, so they might try to internalize that and learn what they need to do better or what they need to work on?
Well, the easy one is when we invest, we absolutely do.
Right.
Because now we have a relationship and we've spent more time. So Wendell gave us a basis. We wrote a check. Relationally, you know, we're with them. And so we can lean into that company and we can say, let us show you what Wendell says about you. Obviously, they're very receptive to that because Wendell gave them a thumbs up. And we can just point out 1 or 2 things and say, look, here's our top performing portfolio companies. Let me show you how they're a little bit different than you. And then you can use that to maybe make some better future decisions. One build off of that, the most unique proprietary software build we got is the behavioral assessment survey. So we put every human being into one of 22 profiles. And those profiles are meant to get through the pitch, the behavior modification, and all this stuff people do. And it really figures out how you are hardwired, because we do believe that certain profiles are hardwired better to be an early stage co-founder, CEO.
Oh, we lost Brad right at the wrong time.
Maybe I can pick up on that a
Yeah, go ahead. Pick up that.
Which is that, just from a feedback, and I'm going to answer a little differently, but we we give almost everybody, even who we say no to, the specific reason why we're saying no, or why we're not a fit for us. We're not necessarily telling them that we don't think you're going to be successful. You know, a lot of the times it's you're raising a round that's too large for us, or you've raised too much capital, or, you know, based on the price point that you have in your business model, you know, your current revenue traction is here and we need it to be at least here before we take a look at you. Feel free to cycle back. So most of our feedback is very, it's always transparent feedback, and we're able to say exactly why you're not a fit for us. You know, it's a much narrower case where we're giving feedback that, you know, you should actually seriously look at changing X. You know, sometimes we do if we really, you know, have a lot of experience in that area, or we see something where we just see almost everyone fails who's doing this in their business model. But for the most part, our judgment is not whether or not you're going to be successful as a company, it's whether or not you're a fit for what we're optimizing for.
Yeah. Am I back on?
Entrepreneurs
Brad, you're back now. So you were just talking about the super secret sauce, but then it cut out.
Well, I was going to say, we've got these 3 team building widgets. We got team speed, team disruption, and team morale. And so for our portfolio companies, it allows us to help them build their teams. Think it like super talent management, and we give it to them for free. And because it benefits us to do that. For the non-portfolio companies, we only provide their profile because it's their data. And like Dave said, when we say no to a company, it's not us saying it's a bad company or bad investment or they're going to fail. It's us saying we want to write a check to somebody else and that's a better fit for us. So we would love to give even more feedback, but we just haven't found the tone or the software. We haven't moved that up on the product list for non-portfolio companies yet.
Yeah. Okay, great. So
I would add one thing here, that it's amazing how entrepreneurs value getting some transparent feedback, even if it's just why you're saying no. So we have some of our best sort of quotes about us are from people that we've said no to and why. And they're like, oh my goodness, I'm sorry it's no, but this is the best VC experience ever. And a lot of the people we say no to are sources of referrals for future companies that we've said yes to. Some of our big winners have come as referrals from companies we've said no to and just had a great experience getting to a quick no from us.
Yeah, and I think that's a side effect of how dysfunctional and bad the traditional VC model is, right? Like everyone should, there's common courtesy that when you enter a relationship, once the VC decides they don't want to invest, they should tell the entrepreneur. And yet no one really does that, or very few firms do that.
Right. Well, it's not in their,
our firms do, but
it doesn't work out for the VC model, because if you're that VC, like one of your bigger fears often is that, all right, this company that, you know, they're not really a fit now, but they might be sometime in the next, you know, if they really start taking off in the next 6 months, and I've said no to them, I might not find out, right? And I'll miss that. So I'm just going to tell them string them along, or tell them like, do you really want more information? And yeah, I don't think I think you'd be much better off transparently saying no more quickly, and actually the network effect of that will come back around and give you much more benefit.
Yeah, there's no question. So we had an interesting question come in of, why are you all describing this? You know, is it giving away an advantage, and what's the outcome? And so I'll say, I mean, I kind of organized it. My view is that investors should understand what they're investing in. And just us being transparent, and me pulling in Dave and Brad to be transparent about what we believe is the system that can drive, you know, appropriate returns given the illiquidity of venture. And so, you know, we're all going to take the investors' money for 5, 7, 10 years. And so in return, we need to do a significant premium on public markets, right? So Jumpstart would say, we want to give you kind of 25 to 40% return rate of return, because we're going to take your money for a long period of time. We need to give an appropriate premium. I think it's useful to just be transparent about, why do we think we can do that? I'm sitting here in Nashville, you know, how can I be so arrogant to say I'm going to outsmart all these other really talented VCs? And I should show that. And the best way to show that is to pull in other people that are doing related things and just say, like, here's our mousetrap. Here's why we think it's going to work. And so yeah, I think it's an interesting question. What do you all think about this sort of process?
I would say that one of our biggest surprises as a firm is that as this trend of like more and more demand for these smaller checks has just grown over the last decade, that there has not been more of a response from the investor world to sort of address it. And what we view, the way we view it, is that there's such a supply and demand imbalance, and in our favor really at this stage, that we're not worried about more competitors. Actually, we would benefit from more quote unquote competitors at our stage, because there would still be a massive supply and demand imbalance, and we wouldn't actually compete. We'd collaborate with each other, and it would probably give us better coverage across the country. It's also not very easy to do what either Brad or our firm is doing, because it's not, the move from traditional VC to sort of micro VC or, CVC world was a pretty easy one, because it was just doing the exact venture capital model, but doing it a little bit smaller checks and faster. You can't take that and do it a little smaller and faster and get to what we're doing. You really need to start with a very different operational model. So we're not that worried that there's going to be a flood of people coming in if we talk about what we're doing. And we would actually like to entice more investors into our segment of the market, because it's really needed from the entrepreneurial world's perspective. And we actually think we would benefit for a decade or two from more entrants on the investor side before we get harmed.
Yeah, and it's really such a mind mind share or thought process shift that all the VCs on Sand Hill Road or here in Nashville or in Cincinnati, that it's really hard for them to shift out of their, like, I know it when I see it, gut level due diligence process, to a clean slate. Let's figure out what the inputs are and run a fairly automated process.
It's also hard for people to understand how the dynamics are so different at this stage, even though it's just a little bit earlier. Like in the seed Series A world and beyond, it is so competitive, right? There's so much capital, and the VC world is so overcapitalized that all firms have tons of competitors that they would view as pure competition to them. Can't think of a single firm that we view as a competitor to us. Right. I only know a few other firms in our space that we view as collaborators and sort of partners with us. And so, the concept that, we need to find a deal and move quickly so that somebody else won't get it, or to keep it hidden from someone else, just doesn't exist at our stage. At least it never has in the decade that we've been doing this. Yeah. And we don't anticipate it'll exist for at least another decade.
Yeah, so if someone's watching right now and they want to call any of us and get advice on how to start a similar thing, I think all three of us would be welcoming and sort of help them do it.
Absolutely.
Brad talked about your experience of sharing. Is it scary, or what's it like to sort of talk about this? Not a huge audience, but publicly.
My entire business model starts with deal flow. So, when I think of competitors, traditional venture capitalists are competitive with each other because they have such a supply of money and a smaller demand of deals. And if you look at the data, the number of companies raising Series A's is plummeting. So competition for the Series A and beyond is going to get ferocious. And then you see these frothy valuations because the only way you get the deal is offer better terms. So seed is
and that's great for us, right? Like really into that.
So you're going to see a shift. Just a mega trend that's already started to revenue. And there's going to be other, if we have competition, it's not going to come from other venture capital equity funds. It's going to come from other alternative, lending sources where we have to explain to a company there is a value proposition to selling off equity, right? Because you're never going to lose your home and you don't have to pay anything unless you have a positive outcome. But we're great sharers. We got our own LPs, and I'm actually going to pitch Dave a big idea when we get off the call.
Okay, good. I want a commission of that if it comes out. So, okay. So the thing I got hit with an email, or maybe it was on LinkedIn, I can't remember, for us to talk about how the venture studio model impacts this. I view venture studio as very different than what we're doing. My view of venture studio is I have a product design team, I have devs, and if you have an idea, partner with me and I'll help you bring it to life. And Jumpstart is kind of the opposite of that. I mean, so we feel like we'll bring industry connections, we'll bring capital, we'll bring assistance and strategy and help with reimbursement. What we won't do is do the dev and the product. But what do y'all think about the venture studio market?
It's different. I mean, if I like, metaphors or comparing things, but that's like saying, tell me how a large cap domestic U.S. fund is different from a small cap foreign fund. They're just different.
Yeah. Right.
And so I don't need to attack it. I don't need to love it. It's not what we do. But if someone has a model that works for them because it's in their belief system, their experiences, and then by all means, do it. But it's a completely different model than, like you said, we are profiling, we are selecting, and then we are bringing, our connections to the table, and we're all about scale. And so it's just completely different. I know quite a few venture studios. Some do great, some don't.
Yeah. Right.
And I think something that Brad said is just really important right there, which is that, none of us are trying to say that like the way in which we invest in our model is the only way to make money or the best way to make money. There's just an unlimited number of ways that you can make money sort of in the private company world. And what we're just saying is, this method that we're using is a fairly unique one that's addressing a very previously unaddressed segment of the market. And it's not meant in any way as sort of a statement that it's the only correct way to do it. There's tons of alternative ways, and many of which are very creative and are going to be very successful that are outside of what we do.
Yeah, I agree with that. Okay, so the last question I want to end with is, a lot of people in the audience are either current or potential investors in funds, in our funds, in other people's funds, in venture and early stage funds in general. And I'm interested in with you all have talked to a lot of investors over many years. What's the most important due diligence questions an investor can ask of you, but that a lot of times they don't? Like, what question do you feel like the best investors really kind of ask about, but most people don't think to ask?
You want to kick off, Dave?
Yeah, the best questions they ask. I think most investors that we talk with, the initial engagement that when we meet with them is more around them struggling to understand like why we break all these perceived best practices of the venture world. So I think so many of the questions that we get are sort of why the heck do you do this or this? A lot of the good ones ask us a lot more questions about sort of data and show, we've been around since 2012. We've got, we're on fund 4 right now. We've got a lot of historical data that proves out that our initial thesis was largely correct. And I think a lot of the smarter investors go right into, asking us to, hey, show me your initial thesis, show how, what's worked, well, what's worked differently than what you expected, and show me sort of the math behind the outcomes and how that's, mapped to what you're saying. But again, that's rare because that's a very sort of data-driven venture investor that's not a very common profile. Yeah. Because in general, venture investors, historically use their own subjective analysis to sort of cherry pick out venture firms where they have sort of done their subjective diligence and believe that those venture partners are the best ones to sort of use their gut feel and be visionaries and pick out the winners and sit on the boards. And so it's the challenges on the investor.
And there wasn't long track record of data particularly. I mean, it's like maybe there's a brand association, but it wasn't really repeatable.
Yeah. Yeah, so I didn't quite answer your question exactly, but.
Well, that's okay. Okay, Brad, do you have anything?
Yeah, so I definitely would. I wish, like Dave, that somebody would nerd out with me on the math, and I would totally convince them. But I'm going to put my CFP hat back on. And when I was a CFP and I would talk to high net worth clients about their portfolio, it was all about asset allocation. So I wish people would, if they spend any time at all on the opportunity that's before us, I wish they would ask me, why don't I put all of my money in this category? So when you talked about a premium, you know, I would challenge, I bet most people listening, if I said, what do you think the price point change of the stock market in percentages, what's been the average annualized return over the past 20 years? And the answer is 4%. Mm-hmm. And most people are going to freak out. They're going to say, no way, no way. Look it up after the call. It's 4%. And then after you pay taxes and your financial advisor charges you a point on that, you're at 2%. Well, why would I invest in 2%? I'd rather spend my money. So to think that I should put 80% of my money in the public stock market seems crazy. So I wish they would ask me about how much do I have in private markets, my own fund, and I invest in other funds too, because I believe in broad diversification. So, and the answer is greater than 50%. So I would love to have that conversation from an asset allocation standpoint with financial advisors and high net worth, but it rarely gets asked of me.
Yeah, I love that line of questioning. The other one that I think people should ask is really just the incentive structures, right? So how are you paid? How is your staff paid? And like, how does this all line up? Because to me, that just drives human behavior. And so we've thought a lot about how can we align things so that the LPs and the GPs, my team, and the portfolio companies are all aligned. And a lot of investors don't, they know it's a 2 and 20 thing, but they don't really focus more on like, okay, how does it really flow? And not all the new VCs are 2 and 20. Like we're not 2 and 20. And so you can dig into the incentive structures, I think, and learn a lot about how the fund's going to behave. Okay, any closing ideas or things we didn't touch on that y'all want to?
No,
I just really enjoyed this. And Dave, I really enjoyed listening to your perspective because it makes me think, you know, when I started this, I was a lunatic and there's at least one other lunatic around. So thank you. Yeah,
well, maybe you're both lunatics, but you're going to be really wealthy lunatics with happy investors. Okay, well, thanks, guys. I really appreciate it.